The air inside the treaty room of the U.S. State Department on June 8, 1974, was thick with a tension that transcended mere diplomacy. It was the heavy, suffocating atmosphere of an empire fighting for its economic life. Secretary of State Henry Kissinger, a man who viewed the world as a chessboard where nations were merely pawns to be sacrificed or crowned, sat across from Prince Fahd of Saudi Arabia. The cameras flashed, capturing forced smiles and firm handshakes. But the true negotiation had taken place in the shadows. Orchestrated by a steely-eyed bond trader named William Simon, the newly appointed Treasury Secretary. The United States was bleeding. The Vietnam War had drained the Treasury, inflation was tearing through the fabric of American society like a wildfire, and the 1971 default euphemistically called the suspension of gold convertibility by President Nixon had left the dollar untethered, floating in a void of confidence. The deal struck that summer was a masterstroke of geopolitical alchemy. It was a simple, Faustian bargain. The United States would provide the House of Saud with absolute military protection and advanced weaponry, guaranteeing the survival of their dynasty against enemies, foreign and domestic. In exchange, the kingdom would price every single barrel of crude oil in U.S. dollars and, crucially, recycle those surplus petrodollars back into U.S. Treasury bonds. It was the birth of the petrodollar, a mechanism that effectively replaced gold with oil as the backing for the American currency. For 50 years, this agreement stood as the invisible architecture of the global economy. It allowed the United States to run deficits that would have crushed any other nation, exporting its inflation to the rest of the world while importing tangible goods and resources in exchange for paper IOUs. It was the exorbitant privilege that French Finance Minister Valéry Giscard d'Estaing had bitterly decried, weaponized into a perpetual motion machine of American hegemony. Every time a nation needed energy, they had to purchase dollars, creating a synthetic, artificial demand for the U.S. currency that had nothing to do with the productivity of the American worker and everything to do with the geological lottery of the Arabian Peninsula, the bond market, the stock market. The very valuation of your home and your retirement act, and all of it rested on this single, secret pillar, erected in the desperation of the 1970s. The world assumed this arrangement was permanent, a law of financial physics as immutable as gravity. The mainstream financial press, lulled into a stupor by decades of normalcy bias, treated the relationship between Washington and Riyadh as an eternal marriage, unbreakable and sacrosanct. But on June 9, 2024, exactly 50 years after that seminal agreement was formalized under the United States-Saudi Arabian Joint Commission on Economic Cooperation, the clock ran out. There was no grand ceremony in the Rose Garden. There were no joint press conferences, no commemorative coins, and, most disturbingly, no renewal. The silence that emanated from both capitals was not an administrative oversight, it was a deafening geopolitical scream. The mainstream media, preoccupied with domestic political theater and celebrity gossip, relegated the news to footnotes, if they covered it at all. They failed to grasp that the bedrock of the global financial system had just shifted. The expiration of the petrodollar agreement was not merely a bureaucratic deadline, it was the formal acknowledgement of a reality that has been festering since the first Russian tank rolled into Ukraine, and the first G7 sanction froze sovereign assets. The Saudis, observing the weaponization of the dollar against a G20 nation, realized that the security guarantee of 1974 had become a liability, the protector had become the predator. This is not a story about oil prices or stock market corrections. It is a story about the end of an era and the violent birth of a new monetary paradigm. We are witnessing the unwinding of the post-World War II order, a structural disintegration that rivals the collapse of the Bretton Woods system in 1971, or the fall of the Berlin Wall in 1989. The difference today is that the transition is not being broadcast on nightly news. It is happening in the ledger entries of central banks, in the encrypted channels of the Shanghai Gold Exchange, and in the strategic stockpiling of physical commodities by nations preparing for a winter of currency debasement. The petrodollar is dead, and what is rising from its ashes is not a new fiat currency but a return to the oldest, most brutal truth of economics. That ultimately trade requires trust, and when trust in paper evaporates, the world returns to collateral that cannot be printed. We are entering the age of the petrogold. To understand the gravity of this moment, we must first strip away the sanitized version of history taught in economics textbooks and examine the raw, visceral mechanics of how the dollar maintained its supremacy. The petrodollar system was never about free trade or market efficiency, it was a protection racket on a planetary scale. By forcing the world to conduct energy trade in dollars, the United States created a captive market for its debt. Consider the implications. If Japan wanted to keep its factories running, it had to buy oil. To buy oil, it had to buy dollars. To hold those dollars, it had to buy U.S. treasuries. This circular flow of capital meant that the United States could spend without limit, funding massive military expansions and domestic welfare programs, knowing that foreign central banks would dutifully absorb the issuance of new debt. It was a checkbook that never bounced, funded by the labor and resources of the rest of the world. This mechanism suppressed US interest rates for decades, creating the illusion of prosperity and allowing the financialization of the American economy to metastasize until the paper claims on wealth dwarfed the actual wealth itself. However, the cracks in this edifice began to appear long before the official expiration of the Saudi deal. They started as hairline fractures during the 2008 financial crisis, when the Federal Reserve demonstrated that it would print any amount of money to save the banking system, prioritizing Wall Street solvency over the purchasing power of the currency. But the fracture turned into a chasm in February 2022, when the United States and its allies froze over $300 billion of Russian central bank reserves. The message sent to the global south was unmistakable. Your dollar reserves are not your money. They are a permission slip from the U.S. Treasury, revocable at any moment of geopolitical disagreement. For nations like Saudi Arabia, China, and Brazil, this was an existential wake-up call. The risk-free asset had suddenly introduced a massive counterparty risk. If the U.S. could confiscate the savings of a nuclear power, what chance did a smaller nation have? This realization triggered the most aggressive accumulation of physical gold by central banks since the data began being recorded in the 1950s. According to the World Gold Council's 2023 and early 2024 reports, central bank buying has reached fever-pitch levels, led not by Western allies, but by the geopolitical East. The People's Bank of China has officially added to its gold reserves for 18 consecutive months, though contrarian analysis suggests the unofficial numbers are vastly higher, hidden within sovereign wealth funds and state-owned banks to avoid panic in the markets. This is not merely diversification. It is a defensive fortification. They are trading treasury bonds promises to pay in devalued currency for the only asset that has no counterparty liability. The Saudis, observing this, have quietly begun accepting yuan for oil transactions, a direct violation of the 1974 spirit. But more importantly, they are looking at the Enbridge project, a multi-central bank digital currency platform developed by the Bank for International Settlements, BIS, that allows for instant, cross-border settlement using local currencies, completely bypassing the SWIFT system and the U.S. banking correspondent network. The pipes of the financial plumbing are being relayed, and they bypass New York entirely. The Saudi betrayal, as it will likely be labeled by Western pundits, is actually a rational pivot towards multipolarity. Crown Prince Mohammed bin Salman has made it clear with his Vision 2030 that the kingdom's future lies not in being a gas station for the West, but in becoming an investment powerhouse integrated with the rising economies of Asia. The numbers support this pivot. China is now Saudi Arabia's largest trading partner, not the United States. Why would the kingdom continue to price its most valuable export in the currency of a nation that is its declining customer? A nation whose debt-to-GDP ratio has spiraled past 120%, and whose political stability looks increasingly fragile. The expiration of the 50-year deal acts as the removal of the keystone. The arch does not collapse immediately, but the structural integrity is gone. The demand for dollars, previously artificial and enforced, is now subject to the whims of the market, and the market is looking at the U.S. fiscal situation with growing horror. We are witnessing the Trifon dilemma play out in its final, terminal phase. Robert Trifon, an economist in the 1960s, posited that the issuer of the global reserve currency must run persistent trade deficits to supply the world with liquidity. But eventually, those deficits would become so large that they would undermine confidence in the currency itself. We are there. The United States is currently adding $1 trillion to its national debt every 100 days. The interest payments alone on the federal debt have surpassed the entire defense budget. This is a mathematical singularity. There is no way to tax your way out of this, and there is no way to grow your way out of it when productivity is stagnant. The only solution is inflation, financial repression, where the value of the debt is inflated away. The Saudis know this. The Chinese know this, and they are exiting the theater before the fire marshal locks the doors. This brings us to the convergence of two powerful engines that are driving us toward a monetary reset: the engine of macroeconomic insolvency and the engine of physical scarcity. Engine 1 is the fiscal dominance of the United States. The Federal Reserve is trapped. If they keep interest rates high to fight inflation, they bankrupted the U.S. government through interest expense, and the regional banking system through commercial real estate losses. If they lower rates to save the government and the banks, inflation reignites with the fury of the 1970s. But this time, without the demographic tailwinds or cheap energy that helped the Volcker stabilize the system. We are seeing the phenomenon of fiscal dominance, where the central bank loses control because the Treasury's issuance is so massive it overrides monetary policy. The bond market, specifically the long end of the curve, the 10-year and 30-year yields, is beginning to revolt. The term premium, the extra return investors demand for lending over long periods, is rising, signaling a loss of faith in the long-term value of the dollar. Engine 2 is the physical reality of the supply chain. For 40 years we lived in a world of abundance, where just-in-time logistics and cheap labor from China kept goods prices low. That era is over. We are entering an era of resource nationalism and supply chain fragmentation. The green transition alone requires quantities of copper, silver, nickel, and lithium that simply do not exist at current prices. The International Energy Agency's own reports admit that to meet the 2030 targets, the world needs to discover and mine more copper in the next 10 years than has been mined in all of human history. Yet, capital expenditure capex in the mining sector is at multi-decade lows. Why? Because the ESG mandates and the obsession with short-term quarterly profits have starved the old economy of capital. We have printed trillions of paper dollars, but failed to invest in the hole in the ground that produces the stuff the world actually needs. When these two engines collide, a flood of paper, currency meeting a shortage of physical resources, the result is not just inflation, it is a currency crisis. The Saudis are positioning themselves at the intersection of this collision. By joining the BRICS alliance, which they did formally in early 2024, they are aligning with the commodity producers against the commodity consumers. The BRICS bloc now controls the majority of the world's oil, a massive chunk of its gas, and a dominant position in the strategic metals required for the future economy. They are building a closed-loop system where they can trade these resources among themselves without touching the dollar. Picture a transaction where Saudi oil is sold to China for gold-backed yuan, which Saudi Arabia then uses to buy Brazilian soy or Russian wheat. The dollar is nowhere in this chain. It is A critical case study of this shift is the recent behavior of the gold price relative to real interest rates. Historically, gold and real rates, nominal rates minus inflation, have an inverse relationship. When rates go up, gold, which pays no yield, typically goes down. This correlation held for 2 decades, but starting in late 2022 and accelerating through 2024, this relationship broke. Real rates soared as the Fed tightened, yet gold smashed through all-time highs. This decoupling is the smoking gun. It signifies that the market no longer views gold merely as an inflation hedge or a currency pair. It views gold as a sovereign default hedge. The market is pricing in the possibility that the U.S. Treasury might effectively default not by missing a payment, but by paying back in currency that has lost significant purchasing power. The rise of gold is the market's vote of no confidence in the fiscal trajectory of the West. The expiration of the Saudi deal removes the artificial dampener on this price discovery. Without the mandatory recycling of oil profits into treasuries, that capital is now free to seek true stores of value. The implications for the average investor are profound and terrifying. The 60/40 portfolio, 60% stocks, 40% bonds, was built for a world where bonds protected you when stocks fell. But in an inflationary debt crisis, stocks and bonds fall together. We saw a preview of this in 2022, and the expiration of the petrodollar accelerates the dynamic. If foreign demand for treasuries dries up, yields must rise to attract capital. Higher yields crush stock valuations and destroy bond prices. The safe haven of the last 40 years has become the epicenter of the risk. The immense liquidity that was trapped in the U.S. bond market is looking for an exit, and the door is narrow. It is trying to squeeze into assets that cannot be printed: land, commodities, industrial capacity, and, principally, gold. This is not a speculative mania. It is a run on the bank of the global reserve currency. As we stand on the precipice of this new era, it is essential to elevate our perspective from the transactional to the philosophical. Money is not wealth. Money is a claim on wealth. It is a social contract, a suspended agreement that society accepts a token in exchange for time and energy. When that contract is violated, when the issuer of the token debases it to fund its own survival, the society instinctively searches for a new anchor. History is littered with the corpses of currencies that failed this test. From the Roman denarius to the assignats of the French Revolution to the Reichsmark of Weimar Germany, in every instance the collapse was preceded by a period of denial, where the political elite assured the populace that the laws of economics had been suspended, that debt didn't matter, and that prosperity could be legislated. We are living through that period of denial right now. States' half a century of dominance. It allowed us to live beyond our means, to fight wars on credit, and to consume the world's resources with a currency we could print at will. But all debts must be paid, either by the borrower or by the creditor. The Saudis have decided they will no longer be the creditor of last resort. The bill has come due, and the cashier is waiting. The sun that rose over the Arabian desert 50 years ago to illuminate the American century is now setting, casting long shadows over a world that is rapidly rediscovering the ancient, golden truth of value. To understand why the expiration of the 1974 Petrodollar agreement is not an isolated event but the final nail in the coffin of the post-Bretton Woods order, we must look beneath the surface of the headlines and inspect the rotting plumbing of the global financial system. The average investor looks at the S&P 500 hitting all-time highs and assumes the system is healthy, mistaking the fever flush of inflation for the rosy glow of vitality. But if we turn our gaze to the Bank for International Settlements, BIS in Basel, Switzerland, the central bank of central banks, we find them quietly constructing the escape hatch. It is called Project Enbridge. While the Western media was distracted by the theater of debt ceiling debates in Washington, the BIS, in conjunction with the central banks of China, Hong Kong, Thailand, and the United Arab Emirates, successfully completed the pilot phase of a multi-central bank digital currency MCBDC platform. This is not some futuristic experiment. It is a fully functional ledger-based transaction system that allows nations to settle cross-border trade instantly, using their own local currencies, without ever routing a single cent through a New York correspondent bank. This is the technological executioner of the SWIFT system. For 50 years, the United States maintained its leverage over the world because every major oil transaction had to clear through U.S.-controlled pipes. If Washington didn't like your politics, they could squeeze the pipe. Enbridge bypasses the plumbing entirely. It effectively creates a parallel nervous system for the global economy, one where the dollar is just one option among many, rather than the mandatory oxygen in the room. The implications of this infrastructure are already visible in the raw data of the Treasury International Capital Tick reports, though one must know where to look to see the hemorrhage. If we examine the TIC data from late 2023 through the first quarter of 2024, we see a pattern that mainstream analysts dismiss as seasonal, but which contrarian analysis reveals as structural divestment. China's holdings of U.S. Treasury securities have fallen to levels not seen since 2009, dropping below the psychological $800 billion mark. But the divestment is actually far more aggressive than the headline number suggests. When we adjust for the valuation effect, the change in the value of the bonds due to interest rate fluctuations, and account for the mysterious rise in holdings by Belgium and Luxembourg proxies, often used by sovereign accounts to mask their activity, the trend is a straight line down. They are selling into every rally. This is the engine 1 of our crisis framework, the sovereign strike. The largest creditors of the United States are going on strike. They are no longer willing to finance the American deficit at negative real rates. This forces the U.S. Treasury to issue more debt to domestic buyers, crowding out private investment, and forcing the Federal Reserve into a corner where they must eventually become the buyer of last resort, a move that will signal to the market that the inflation fight has been abandoned for the sake of solvency. This brings us to the most critical, yet least understood, dynamic in modern finance: the fiscal dominance trap. In the International Monetary Fund's (IMF) October 2023 Fiscal Monitor Report, explicitly in the section regarding climate crossroads and fiscal policies, there is a terrifying admission buried in the technical appendices. The IMF projects that global public debt will inch toward 100% of GDP by the end of the decade. But for the United States, the trajectory is vertical. The Congressional Budget Office (CBO) notoriously released a long-term outlook in early 2024, showing U.S. debt to GDP hitting 166% by 2054. But their models assume no recessions and low interest rates, a statistical fantasy. When we apply a realistic recession probability model, similar to the one used by hedge funds like Bridgewater Associates, the debt spiral accelerates. We are currently paying over $1 trillion annually in interest. This creates a feedback loop. The government must borrow more just to pay the interest on the old debt, which drives rates higher, which increases the interest bill, which requires more borrowing. It is a mathematical death spiral. In this environment, the risk-free rate of the U.S. Treasury becomes the return-free risk. The Saudi decision to let the Petrodollar deal expire is simply them looking at this balance sheet and deciding they do not want to be the bag holder when the music stops. The second engine driving this convergence is the commodity supercycle of scarcity, which is colliding violently with the paper supercycle of debt. While Western governments are obsessed with the nominal value of their stock markets, the BRICS nations, Brazil, Russia, India, China, South Africa, now joined by Saudi Arabia, Iran, UAE, Egypt, and Ethiopia, are obsessed with the control of physical atoms. The expansion of BRICS in 2024 was not a social club enlargement. It was a hostile takeover of the global commodity supply chain. This bloc now controls 42% of global oil production, 72% of rare earth minerals, and over 50% of the world's wheat supply. They have effectively cornered the market on human survival. The net zero ambitions of the West play directly into this trap. To build the wind turbines, solar panels, and electric vehicle batteries mandated by Western governments requires copper, nickel, cobalt, and silver. Who controls the processing and refining of these metals? China. Who controls the energy required to extract them? The expanded BRICS alliance. Consider the silver market as a microcosm of this imbalance. According to the Silver Institute's 2024 World Silver Survey, the global silver market has been in a structural deficit for 4 consecutive years. Demand from the solar industry photovoltaics exploded by 64% in a single year, yet mine production fell by 1%. We are depleting above-ground stockpiles at a rate that is mathematically unsustainable. The COMEX and London Bullion Market Association (LBMA) vaults are bleeding inventory, yet the price of silver remains suppressed by the paper derivatives market, where billions of ounces of paper silver are traded daily by high-frequency algorithms that have no intention of ever taking delivery. Perfect storm for the great reset of the monetary order. This is not the conspiracy theory version of a reset. It is the mechanical reset of pricing. The converging point is the moment when the bond market breaks. We saw a preview of this in the UK during the LDI crisis of September 2022. when the British bond market collapsed, threatening to wipe out the nation's pension funds within hours. The Bank of England was forced to intervene and print billions of pounds to buy the bonds, pivoting from tightening to easing in a single afternoon. This will happen in the United States. The moment the 10-year Treasury yield spikes to a level that threatens the solvency of the U.S. government or the banking sector, down a persistent, agonizing loss of purchasing power, coupled with periods of acute financial stress where liquidity vanishes, the Enbridge system and the BRICS gold settlement mechanisms will gradually eat away at the dollar's market share in global trade. It begins with oil, then moves to copper, then agricultural commodities. Slowly, then suddenly, the U.S. dollar will remain a currency, perhaps even a major one, but it will lose its exorbitant privilege. It will become just another currency, shackled by the reality of its issuer's balance sheet. For an economy structured around the assumption of infinite credit card limits, having to pay cash will be a shock equivalent to a cardiac arrest. What, then, is the imperative for the individual who sees this storm on the horizon? It is to become your own central bank. The era of passive investing, of blindly dumping money into a 401k and assuming the government will manage the economy is over. You must eliminate counterparty risk. If your wealth depends on a promise from a broke government or an over-leveraged institution, you do not own that wealth. You merely have a claim on it that may not be honored. True ownership is the possession of assets that have no liability attached to them. Physical gold and silver are the only financial assets that are not someone else's liability. They are the only outside money in a system of inside money. But beyond precious metals, this extends to resilience in all forms, skills, local community networks, and energy independence. The goal is to move from return on capital to return of capital. Survival is the new growth. Ultimately, the expiration of the U.S.-Saudi agreement is a lesson in the impermanence of power. Empires, like stars, have life cycles. They are born in the fusion of vitality and discipline. They expand through commerce and conquest. They mature into administrative arrogance, and they collapse under the gravity of their own debt and decadence. The United States is currently fighting the laws of physics, attempting to maintain unipolar dominance with a balance sheet that suggests bankruptcy. It is a battle that can be delayed, but not won. The Saudis, with their millennia-long perspective of desert survival, understand that allegiances must shift like the dunes when the wind changes. They have checked the weather, and they see the storm coming from the west. As we look back at that treaty room in 1974, the silence of the expiration in 2024 echoes with a profound finality. The ink on William Simon's deal has faded. The handshake has gone cold. The artificial dam that held back the waters of economic reality for 50 years has cracked, and the flood is here. It is not an end of the world, but it is certainly the end of their world. For those who are awake, for those who hold the map of history and the compass of hard assets, the collapse of the illusion is not a catastrophe. It is the greatest opportunity of our lifetimes to reclaim the value of our time, our labor, and our liberty. The petrodollar is dead. Long live the truth.